Hello and welcome to our review for June, looking back at the events of last month. So we've now had the coldest spring since 1962, but the summer at last is fast approaching. A mile-wide tornado has caused devastation in Oklahoma. A soldier was brutally murdered in a London street. Syria continues to be torn apart. The new Mary Rose Museum has opened in Portsmouth. Technology allows us to see representations of the people who lived over 500 years ago. And so it goes on. Good news always mixed with bad news. We all constantly face new challenges, and making the right decisions may require some help. We don't profess to have all of the answers here at Hurst Financial Consultancy, but of course we do our best to support our clients in guiding them toward making the right choices. In this month's bulletin, I'll concentrate on some of the challenges facing the economic world at the moment, and have selected just a few topics. As always, please feel free to contact us with your comments or questions, or simply to review your arrangements to ensure they're still appropriate for your needs. With regard to market commentary, markets continue to feel the effect of QE policies that have been put in place in many countries. The effect of QE has driven down the yields on government bonds, referred to as gilts, and this is forcing investors to seek their returns from assets that are riskier, such as equities, and this has been driving these markets up, and they're starting to show increasingly healthy gains, most notably in Japan, which has recorded the greatest growth of the main markets over the past year. The FTSE All-Share Index has shown a rise for 11 consecutive months, which is unusual, so it would be wise to be prepared for this market to soften or correct a little in the not too distant future. Indeed, since writing this and during the course of the last couple of days, markets have already shown their ability to soften. Investments are, of course, a medium to long-term commitment, and as we all know, there has always been volatility where we see ups and downs in prices and values. During times of such volatility, it's important that investors stay in their seats to maximize their returns and avoid any unnecessary losses. This review will continue to provide some opinion about why returns on equities may be high at a time when growth forecasts are being reduced. As long as inflation in the UK stays above the Bank of England's target, there is little scope for our economy to expand. Negative wage growth is the largest drag on the UK economy and has continued to be since 2010. Prior to the crisis, high inflation had been matched by increases in wages, but the drop in wage growth has been greater than the recent fall in inflation, so there is less real money to spend in the economy, which ordinarily would help boost growth. There are calls for the Chancellor to alter the pace of the austerity plans to help stimulate growth in the UK economy. He has made cutting the deficit his priority and has reduced the imbalance between what the government spends and the revenues it receives, but the UK's debt is still rising. Globally, the OECD predicts growth of around 3.1% for this year, rising to 4% for 2014, which is a slight fall from the previous prediction. So there is a disparity between the buoyant asset markets, mainly equities, and the sluggish rate of economic growth, and this may be a sign of a market correction to follow. Turning our attention to the United States, their recovery is carrying on, although it is still modest in real terms. The US housing market is once again declared buoyant, and new housing projects have doubled since 2011. However, behind the scenes, part of the buoyancy can be attributed to the manipulation of available property in the markets, where lenders, including those selling properties in foreclosure, are controlling the supply by reducing the number of properties available for sale, thus increasing demand and inflating prices as a result. In Japan, we've seen dramatic gains in their stock market, with over 60% having been recorded during the past year as a result of the economic stimulus by the massive QE project run by the Bank of Japan. This has led to a fall in bond yields, and investors have sought higher returns, and they've piled money into the Japanese stock market, which has pushed up the returns. Whether these returns can or will continue long term is of course uncertain, and over the week since the end of May, the Nikkei index lost over 8.3% since reaching its 5.5-year high, again demonstrating the volatility of this market. This quite rapid correction caused its own shockwave in other markets, which have returned a little from their previous year highs. The European story rumbles on. The future of the UK's membership of the EU is an issue that will run on until the intended in-out referendum in 2017, but debate over whether it is right or wrong to remain in the EU will be interesting. For example, in 2011, over half of the UK's trade was with EU countries. Therefore, leaving the UK would mean renegotiation trading terms with these EU members. In addition, despite the obvious cost savings from leaving the EU membership, there would be alternative costs. For example, support would be needed to replace the UK agricultural subsidy. Moves to strengthen the monetary union within the EU by developing monetary and fiscal union could lead to a more federal-style structure which, if the UK left, could have a negative effect on its current role as a leading financial trading centre. Recent easing up of the deficit reduction targets in several Eurozone countries will give them more time to cut their deficits because they were considered too ambitious in the face of rising unemployment and recession. The European Commission is expected to be changing its policy in June to take the focus away from austerity and instead target structural reforms to try to revive economic growth. Many of our investment portfolios contain some exposure to the emerging markets. One product of the US QE was that cheap US money was partly responsible for the rally over the past 4 years in emerging market equities, bonds and currency. Concerns are being voiced now that once the fiscal stimulus in the US starts to taper off, emerging markets could suffer with lower growth. The globalizations of markets, where now so many are interrelated, means, for example, that austerity measures in the Euro countries have a knock-on effect in China. This month's graph shows our various portfolios that we risk rate with a 3 out of 10, a 5 out of 10 and a 7 out of 10. And here we're comparing them to the FTSE 100. And as you can see, the careful selection of balanced assets within our portfolios leads to much smoother performance. And so this is why we continue to use a diverse range of investment assets for our clients. Bringing this review to a summary, as you know, we continue to monitor markets on a daily basis, but any reaction by us is based on a measured approach to reviewing carefully selected investment portfolios that are chosen to suit your individual investment needs. We have seen a correction in markets over the last 10 to 15 days, but don't see this as anything that requires a rejig of any of the investments that we're currently using, and we expect matters to return to a more normal, progressive condition as the summer moves forward. As always, please feel free to contact us if you have any questions or concerns, and we will be happy to help. All of our contact details are on the next slide.